Imagine you've just built a trading algorithm. You run a backtest, and the results show an incredible 100% net profit. On the surface, it looks like a flawless money-making machine. Cautionary tone. Evaluating a strategy based entirely on that final profit number is risky. A high return in a vacuum hides the severe market turbulence your portfolio had to endure to get there. Look at the DD detail table. Pay attention to these maximum drawdown values. Your algorithm might finish up 100%, but could suffer a terrifying 80% capital loss. Pan down to the recovery rows. Spending hundreds of days recovering isn't an edge, it's gambling. To separate pure luck from systematic skill, professional traders measure the amount of excess return generated for every unit of risk taken. Before we can measure risk accurately, we first need to define what our money could have earned by taking zero market risk. This is known as the risk-free rate. It is the guaranteed baseline yield generated by holding ultra-safe assets like government bonds. For an algorithmic strategy to be viable, it must generate returns higher than this baseline. Otherwise, there is no mathematical justification for exposing your capital to the market. If your robot's performance fails to comfortably clear that zero-risk threshold, the trader has accepted market stress for a reward they could have found in safe haven bonds. This brings us to the Sharpe ratio. It is the industry standard metric used to calculate exactly how much excess return a strategy yields for every unit of risk taken. The formula starts by isolating true profit. We take the strategy's total net return and subtract the risk-free rate. Next, we divide that excess profit by the annual standard deviation. This accounts for total volatility, measuring the size of the price swings experienced. This scorecard shows our risk and reward metrics. Because market returns roughly follow a normal distribution curve, an annual Sharpe ratio approaching 3.0 indicates a strong balance of risk and reward. The Sharpe ratio provides a mathematical score for market volatility, helping traders determine if the return justifies the path taken to achieve it. But the Sharpe ratio has a limitation. Because it uses the total standard deviation, it penalizes all market volatility equally. If your strategy perfectly predicts a massive upward price spike, the Sharpe formula registers that sudden gain as volatility. It lowers your score for making a fast profit. To address this, many traders use the Sortino ratio. The Sortino formula removes upside volatility from the equation. It measures only downside volatility, separating the Sharpe losses from the profitable gains. Looking at the risk and reward scorecard again, checking the annual Sharpe ratio right next to the annual Sortino ratio provides a clearer view of your true market exposure. Sortino provides a more practical picture for real-world application because it only lowers your score for the volatility that threatens your capital. This wide view shows a monthly P&L percentage heat map. It represents the traditional, broad way of looking at a portfolio's profits over time. While net P&L shows what happened to your balance, the Sharpe and Sortino ratios show how it happened. These ratios provide a rigorous method to validate whether a robot's underlying logic is efficient or if it simply benefited from a temporary window of favorable market conditions. Here on the simulation results screen, negative values in the annual Sharpe and Sortino ratio columns act as immediate warning signs. The strategy is statistically unsafe, regardless of what the gross P&L might say. A master algorithmic trader avoids chasing the highest potential returns. By relying on Sharpe and Sortino ratios, they engineer strategies designed to survive, scale, and generate wealth safely over the long term.